Hi, good morning. Good morning, everybody, and welcome to this webinar on sustainability reporting in Oman. It's a pleasure to be able to speak to you today and talk you through some of the recent developments which have been happening in the Oman market and the way forward in terms of the sustainability reporting that many organizations in Oman are going to be required to do on into the future. Before we sort of get into the detail, I think there's a few housekeeping points that we can effectively run through and then say we'll start. So just to let everybody know, today's session is being recorded, and we will make sure that recording is available to all the attendees, say following the seminar. So you'll be able to go back and say refer to it as you need to. We did ask you when you enrolled to submit any questions, and we've had a number of questions that have already been submitted. Hopefully we will respond to those questions as we go through the session, but we've also got some time at the end for a Q&A session as well. So if there are any questions, further questions that you have and that you wish to ask, please do put them into the chat during the session, and then we will endeavour to pick them up as we go through. And then finally, at the end of the session, you'll be directed to a feedback survey. We'd be very appreciative if you could fill in that survey to give us some feedback over the course of the session today. Well, with that, let me move into the content, and to begin with, just introduce you to who will be speaking today. So, my name is Charles Batchelor. I'm a partner with KPMG Lower Gulf. So that's the region that serves both the UAE and the Oman market. I've been in the region now for approximately 3 years, and my focus is very much on corporate reporting. So it has been on financial reporting, but at the moment I lead KPMG's sort of ESG and sustainability reporting service line. With me today, I've got two of my colleagues, Lamis Jahar and Khadija Ghanem. Lamis is a director. Lamis specializes in all the things to do with, if you like, the operating model for reporting, and she'll be talking today about how companies actually build their sort of reporting structures. And also Lamis will be talking about one particular reporting framework which is going to be required in Oman from this year, the GRI framework, which we're going to come on to. And then also on me, I've got Khadija, and Khadija is an associate director in our team. Khadija is our technical specialist on sustainability reporting. She's been deeply involved in sustainability reporting for the last 3 years across a number of the different, sort of structures and frameworks. And she today will be covering another framework, the ISSB framework. So those are the team that we've got with you over the course of today. In terms of the agenda and what we'll be covering today, the aim of today is to really introduce you and set the scene around the requirements for sustainability reporting within the Oman market, but actually a bit more globally as well. Over the last few years, we've seen a huge increase in the requirements for sustainability or ESG reporting, and we've seen frameworks being developed. We had an explosion of frameworks. Perhaps they're now consolidating down, and we're going to talk through that. But within the Oman market, particularly at the end of last year, there was an MSX ESG disclosure guideline published, which is going to require from the 2024 year, reporting in 2025, sustainability reports and certain disclosures for MSX. They are required to be prepared under a particular framework, I think called the GRI framework, which we're going to talk about, and they mandate certain metrics that companies in Oman are going to have to effectively publish and disclose. So we're going to talk through the drivers for this, but in order to appreciate that people are coming in from different backgrounds, the way we're going to start is we're actually going to start just by setting the scene a little bit around some of the common terminology and things that we are, are important when you get into ESG and sustainability reporting. We'll then move into the actual sustainability reporting landscape in Oman. So what's the actual landscape going to be, and the key, the key frameworks which we think will be relevant in the Oman market. And then finally, we're going to finish up with a little bit about the way forward. We're going to talk a bit about some of the challenges that we perceive companies may have, and particularly companies in this region, and how they're reporting. Some of the things they need to think about in developing a robust report, which can be relied upon by investors and other potential stakeholders as well. And some of the sort of routes through to actually producing that report. Finally, we will finish up with, as I say, time for any questions. We've had questions submitted. We'll have time for any further Q&A at the end. So that's the agenda for what we're covering. To start with, though, I said it's very much, I would say, around sort of a little bit around setting the scene as far as sustainability reporting is concerned. So in this section, I just really want to introduce you to a few of the almost the sort of key, almost sort of terminology, the key frameworks, etc., which have driven a lot of sustainability reporting. And our starting point actually starts with a global agreement that when the world came together with the UN Sustainable Development Goals. So if we move into, say, onto the next slide, we can talk about a little bit about the UN Sustainable Development Goals. Countries in the UN came together, say in 2015, a set of 17 sustainability goals were developed and agreed by sort of the global community. These effectively are trying to ensure that the world in the future, that we, if you like, hand over to our children and our grandchildren, that world is, it is in a great state. It's a world that is, giving them the opportunity to say, thrive on into the future. And in order to do that, the UN set out these sustainable development goals. What at its heart, and at the core of this, is that organizations and countries are looking to ensure that their public policies or their corporate policies are achieving and helping to achieve these goals. And a big part of any sort of ESG and sustainability reporting is actually explaining to the world how it actually links in and how organizations have achieved these these factors. Now, I would say, though, that it's not, sustainability reporting is not just about how you contribute to these, but these have been a big driver to what companies are trying to say explain. If we move on, I mean, one of the key things that's coming about as a result of these is sustainability risks. If you look at sort of global reports and global sort of surveys around what are the key risks that organizations face, sustainability risks and the broader sustainability risks are very much at the heart of that. Now, clearly, one that receives a huge amount of press is all of the climate risk areas, and certainly sustainability reports. The E in ESG is about environmental, and climate risk forms a big issue for that. Now, I just want to be clear, and again, this is where we're sort of talking about particularly climate risk. Climate risk has different elements to it, and in particular, I broadly sort of look at these into two broad categories. Climate risk drives physical risk for organizations. Now, this is because the climate is changing, the climate is warming, we're having more severe adverse weather events, freezes, floods, etc. They can have a physical impact on businesses, and that's a physical risk coming out of climate. However, businesses do also need to think about another element of climate risk, which is transition risk. We're seeing now many countries, including Oman and the countries in this region, committing to net zero. We're seeing many businesses committing to a net zero target. Net zero means, in effect, net zero greenhouse gas emissions. Now, if you're going to achieve net zero as a country or as a business, that requires change. How companies have operated to date, they are not going to be able to continue to operate in the same way. The way that they have to change their operations and the way that they're transitioning, that's the transition risks. That is part of climate risk. When companies are reporting on their climate risk, they will report on that transition risk as well as the physical risk. And for many organizations, the transition risk is the more significant element. So absolutely, climate risk is part of sustainability, but it's not the only sustainability risk. And at the bottom of the slide, we've got a number of other sorts of sustainability risks. Natural resource crisis, livelihood crisis, infectious disease, debt crises, etc. There are a number of other risks that are coming in throughout this. So we're going to have sort of sustainability risks. Just a couple of other things to be aware of. The next slide, again, on particularly the area of climate, you will keep on hearing the Paris Agreement referred to. This was the agreement that was, say, adopted by countries in the world to limit the rise in temperature, for the globe up, to the aim was 1.5 degrees. Now, in effect, that's driven a lot of the actions around, countries moving to net zero. We should be aware that in certain elements of, again, sustainability reporting, there are requirements to report and assess scenario analysis around how would your company respond to, a 1.5 degree rise in world temperatures, and maybe a 2 degree ones, a 3 degree ones. They will have different economic consequences, and assessing your company's sort of a robustness in, say, to those changes is important. So the Paris Agreement has been a big driver. Again, if we move on, particularly talking about climate emissions, which are, and greenhouse gas emissions, which are a big topic of discussion, you will hear, and say if you haven't come across these phrases already, you will hear a lot about scopes 1, 2, and 3 as far as greenhouse gas emissions are concerned. Now, I really just want to clarify what these are, because they are common terminology and they are quite a big issue in terms of reporting for many, many organizations. Greenhouse gases will be a key thing they report on. The different scopes refer to different, say, types of emissions that companies either cause or influence through their activities. Scope 1 and 2 are the very directly controllable emissions. So if a company does a scope 1 emission, that's a greenhouse gas emission caused directly as a result of the entity's activities. So, you're an airline and you burn aviation fuel as part of your activities. That causes greenhouse gas emissions. So directly as a result of your activities, you make greenhouse gas emissions. So that was an example for an airline. You might be a company that has to, has boilers which burn gas to generate maybe heat or steam or something. That will be a scope 1 emission. So that was very much controllable, directly as a result of activities. Scope 2 emissions, now these are the emissions caused by predominantly the purchase of power by organizations. Because organizations have to buy electricity and they have to buy power. That power doesn't get generated from renewable sources. That means that the purchase of power causes there to be greenhouse gas emissions in its generation. So that's a scope 2 emission, directly as a result of the company's needs for power, that causes greenhouse gas emissions. What we're seeing currently for companies in this part of the world, very commonly, if they do give disclosure, they give disclosure about scope 1 and scope 2 greenhouse gas emissions. Scope 3 is effectively all of the other emissions that could be caused as a result of the entity's activities. And this is across the value stream, both upstream and downstream. So, for example, you buy supplies from your supply chain. That supply chain emits greenhouse gases in generating those products. You require your employees to come into work in the business. That means that they drive cars or use transport to come. That causes greenhouse gas emissions. You're a business that, maybe you're an oil or gas company that sell oil or refined products, which are then going to be used by customers, burned potentially, and generate greenhouse gas emissions. So that's your used product. You might be a financing institution that provides lending or other financing to businesses, which then use that financing in activities that generate greenhouse gases. That's financed emissions. That's part of Scope 3. There are in fact 15 different categories of Scope 3 emissions. For many organizations, this will be their biggest, if you like, value and number in terms of, sort of tons of greenhouse gas. Obviously, a lot of challenges as well in just measuring Scope 3. So that's Scope 1, 2, and 3. And you will hear these phrases very commonly when we talk about sort of ESG reporting. And then the final couple of bits in my just sort of setting the scene area, you will hear also discussion in ESG around the concept of materiality. So if we just say moving on to the next slide, we can talk about the different perspectives on materiality. When we get into a bit more in a few minutes, a bit more of the frameworks that exist, there are different frameworks have different definitions of materiality. And you could talk about outward in or financial materiality and inward out or impact materiality. When we're talking about materiality for ESG, the financial materiality, for those of you on the call who are from a finance background, that is a way very familiar. They define ESG materiality in the same way we define, financial materiality for financial statements. The omission or misstatement of an information could impact on a investor's or user's decision on the business, and it could therefore have a materially financial impact. So that's very much as what's the impact on the business. What you've then got, though, is the impact materiality. Now, this is much more broad ranging, and it says by the activities of the company, they could impact on ESG sustainability factors, which many different stakeholders might be interested in, and not just investors. So we talk about this sort of the financial impact, predominantly for investors, and the broader, impact materiality in terms of the outside world. And different frameworks for sustainability reporting look at different definitions of materiality. So we'll talk about those two when we get into those frameworks. Finally, in the setting the scene area, just if we move on to the last bit before we get into the frameworks, what are some of the key challenges from an Oman perspective? Oman has got its 2040 vision. Oman is looking at a transition to net zero. There are some key challenges there. There are climate challenges, chronic risks, rising temperature, water scarcity, etc. So acute risks. There are obviously also transition risks for Oman. So that's a big challenge, just say nationally for the Oman market. There are also challenges faced in more of the social aspects, such as sort of healthcare, the move towards Omanization. Those have been, referenced as key challenges as well. So these are key sustainability challenges which the Oman nation, the government is looking at, which then companies, effectively businesses, are going to be impacted by. So that was me. I know I've been a quick run through there, but just a little bit about setting the scene as far as some of the terminology was concerned, and some of the things which we talk about as regards sustainability reporting. What I want to move on to now, though, is actually much more of the detail of actually the reporting landscape and the reporting frameworks. So when we talk about sustainability reporting, what I'm going to do is just give you an overview of the nature of frameworks and the global position around sustainability reporting. Lamis and Khadija are then going to drill down in more detail into what we expect to be the major regulations that affect Oman, particularly with the MSX requirements. Now, when we talk about sustainability reporting is part of broader corporate reporting. So when we move on, let's say, looking into sort of the whole area of corporate reporting is becoming a combination of both financial reporting and non-financial reporting. And sustainability reporting is part of the package of non-financial reporting that companies produce. Generally, that reporting package is, primarily it's there to give users of general purpose financial information about, the company. The way I sort of think about it, financial reporting has very often been historical. It's telling you about how the company has performed to date, the profits it's made, the cash it's generated, the asset position it's in. So financial reporting is largely backward looking. Non-financial reporting, and particularly sustainability reporting, is far more forward looking. It's saying, is this organization actually going to be sustainable into the future? I mean, if we move on to the next slide and sort of think about why sustainability reporting, really matters. I mean, I think that, I mentioned at the start of the sort of session, the contribution towards the sustainable development goals, that's important because it's saying, the company's saying to the outside world how they're helping to meet those sustainable development goals. But actually, I think it's also much, much more, if you like, tangible to a business. It's about telling investors and telling the outside world, is this business, the business you're reporting on, actually a sustainable, robust business that is going to continue to generate, cash flows, profits, provide a return to investors on into the future, and that's in the short, the medium, and the long term, into the future. If we're thinking about sustainability reporting in that way, this is absolutely about the ability of the business to, if you like, to be robust, to be a long-term, viable, successful business. It comes down to being incredibly important information as far as, investors and other stakeholders are concerned. And I think that's one of the big reasons we're seeing a growth in sort of sustainability reporting requirements. It's now recognized that this isn't, just companies greenwashing. It's not just companies trying to say that they're great citizens. This is actually core to explaining to stakeholders why the business is going to be a viable, sustainable business. Now, I did say at the start that there are quite a number of different sustainability reporting frameworks. And what we're going to move on to now is to look at some of those frameworks that exist. So on this slide, what we've summarized is some of the sort of core frameworks that are there. And actually, the place I'm going to start is the bottom right-hand side of this slide. That sort of mix of different ones, integrated reporting, TCFD, GRI, SASB, various different frameworks. What we've had in the past and up to now has been many different frameworks existing that drive different aspects of sustainability reporting. Those frameworks have sometimes had slightly different users, so their intended audience has differed. The focus of areas has differed. So, for example, TCFD is all about climate, whereas GRI is much, much broader. SASB was much more sort of industry focused, just around type of investors. So we've had a mishmash of different frameworks that have been around. Now, the MSX guidance that has come out, that is requiring the GRI framework to be the primary framework for Oman. We're going to talk more about GRI, say, in a few minutes. What we are now starting to see happening, though, is that sort of set of almost alphabet soup of different frameworks is coalescing around perhaps a smaller number of more, I'm going to say, sort of robust types of frameworks existing. And in the sort of other quadrants of the slide, we've got some others. The EU, so the European Union, they've gone down their own route. They've produced EU under their CSRD, their Sustainability Reporting Directive. They've created ESRS, European Sustainability Reporting Standards. Large organizations in the EU were required from this year to report under ESRS. That ESRS requirement, it's 12 standards. It's a major sort of reporting framework governed by the sort of EU Council and EU government and the European Commission. And the minute it started with large organizations in the EU, that's going to expand out, and it will expand out to, perhaps global organizations which have got an EU presence as well. That framework, the EU started an assurance journey. There is limited assurance on it this year. That's likely to go to reasonable assurance in future years. So the EU have done their own thing, relevant to EU entities. What we've also got is, if I go to bottom left, the US is doing its own thing. The US is focusing much more on climate. The state of California has already issued climate disclosures. The SEC, I think, has only just, literally within the last few days, issued some proposed climate disclosure rules, which are going to require US companies to give climate-related disclosures. So they are, whereas ESRS in the European Union is broader than climate, the US has stuck to climate. But then in the top left, a lot of the rest of the world, we are expecting to move to ISSB, S1 and S2. The ISSB board was formed a couple of years ago. It actually came out of COP26 in Glasgow. And this is a sister board to the International Accounting Standards Board, all under the IFRS Foundation. And Khadija is going to talk more about these standards later in the session. They've issued last year the first two sustainability standards. So IFRS S1 and S2, S1 being a general standard, S2 being about climate. We are expecting that many organizations in this region, ultimately ISSB will be a required area. And in fact, a lot of the organizations that exist in the bottom, say right of this diagram, a lot of those have actually been subsumed within the ISSB framework. So actually, a lot, the ISSB is taking much more of an oversight role to a broad range of sustainability reporting. GRI still sort of sits outside. I mean, of these different frameworks, I mean, the next slide just talks about a little bit more detail about some of those main frameworks that exist today. You know, SASB, integrated reporting, TCFD, GRI, etc. What we've got there, I mean, they are all slightly different. They've got different focuses. They've got different audiences. Slightly different features. Should be noted that, say, for Oman, the GRI framework, which is quite a broad-ranging, very open framework, followed by a lot of organizations globally, that's the framework which is being initially required under the MSX guidance. So that one is going to be an absolutely critical one for, say, Oman, say, reporters going forward. Okay, finally, before we actually get into the sort of the detail of the MXX and the GRI and ISSB, the final thing I wanted to look at is actually what's specifically happened in Oman. So, towards the end of last year, MSX issued and published their ESG disclosure guidance. So, if we move on to the next slide, we'll just talk a little bit about what that MSX disclosure was. So, MSX, that's the stock exchange, determined that Oman companies, as of 2024, will have to issue standalone ESG reports in line with the Global Reporting Initiative standards. So what that means is that for many Oman companies that haven't been reporting on their sustainability and ESG historically, as of this year, going forward, will have to report under that. That's in common with other stock exchanges. So in Abu Dhabi, for example, ADX issued 3 years ago their requirements for disclosure. And say ESCA in the UAE issued it, and ADX gave guidance as well. So it's bringing Oman, say, markets into line with others in the region. And we're seeing it more globally. And many markets now have some form of disclosures. It should be noted that the disclosures will be mandatory in 2025. So it will be mandatory to disclose in 2025 on the 2024 year. It will be voluntary. It is voluntary to disclose in 2024 on the 2023 year. So you're getting 1 year effectively voluntary, say, grace period. But as of next year, the report will have to come out. In addition to the sustainability report under GRI, MSX has required disclosure of 30 different metrics for ESG factors, climate and other factors as well, and they will go on to an MSX disclosures platform from 2025. So that's going to drive comparability between organizations under the stock exchange. So that guidance came out. So it's GRI and then effectively disclosure. Just if we move on, we can just think about, where is Oman's status currently? We don't say this is complete. We, in preparation for this session today, did have a look at 50% of Oman listed companies and what's disclosed. So we surveyed 56 entities. At the moment, of the 56 we looked at, 75%, so 3/4, didn't give any disclosures really in related to sustainability. So, the majority are not currently giving sustainability disclosures. 16% do make some disclosure on sustainability factors on their websites or in the annual reports. Only 9% actually issued a sustainability report, and out of those who issued the sustainability report, GRI was the most commonly used framework. So in Oman, awful lot of organizations are going to have to start reporting where they hadn't reported previously. So that's sort of looked a lot around effectively, where we're at in Oman, what's happened globally in terms of the different frameworks, and what Oman has got with this new regulation that's come in requiring GRI, and where Oman companies are. What we're going to move on to now, though, is a bit more detail actually into the sort of GRI framework, but also the ISSB framework. The reason that we wanted to talk about ISSB as well as GRI is that our expectation is that the ISSB will become, for this part of the world, also a mandatory framework. So we think that there will be a progression of reporting that's going to happen. So Oman starting with GRI, but it's a sort of no regrets approach. If I was advising a company to say, when you're looking at GRI, it's also worth looking at ISSB. Now, ISSB, the ISSB standards and GRI have a different view. The ISSB standards very much are focused on a financial materiality as a approach, and they are very specifically sustainability standards, and so it's sustainability reports written for the investors, and they should be connected to the financial statements issued by, IFRS issued by the IASB. They, under ISSB, you'd expect them to come out at the same time, same reporting entity, etc. GRI is a much more of an impact or a double materiality approach. GRI not only looks at financial materiality, it also looks at impact materiality, and is for a broader range of stakeholders. So that is going to consider effectively a broader report. The two, they're not say frameworks that are competing. They are absolutely complementary. There's no reason why an organization couldn't give an ISSB compliant, report, and then also, if needed, top that up to make into a full GRI report. But these are the GRI and ISSB are the two we're going to talk about. So with that, I am now going to hand over to Lamise, who's going to look in more detail at the GRI, the Global Reporting Initiative.
Surely. Thank you, Charles. If we can move to the next slide, please. So GRI in a nutshell, let's untangle that. So GRI is an independent and international organization based out of Amsterdam with branches all over the world. It basically helps organizations, businesses, and governments actually understand and communicate their sustainability impact. When looking at GRI, similar to other frameworks, what it helps is assess the environmental, social, and governance performance. And by doing so and being adopted by multiple companies, it will enable for comparison and benchmarking. So as Charles has mentioned earlier, with the alphabet soup of acronyms and standards, there is light at the end of the tunnel, because in March 24th, 2022, IFRS and GRI have announced that they would be collaborating to align ISSB investor-focused sustainability standard requirements with GRI's multi-stakeholder focused sustainability disclosure standards. So allow me to set the scene here for GRI. As you see in the graphic in front of us, basically GRI standards, there are three. The universal standard, which includes GRI 1, 2, and 3. Sector standards, which include different sectors, and topic standards. If I delve a little bit into detail, the universal standards, basically what they do is that they lay the groundwork. They provide the principles and they explain the principles of reporting. While GRI2 looks into the reporting practices and other organizational practices, such as, say, governance or policies. As for GRI3, there in green at the bottom, it basically provides a step-by-step guide into how to determine the material topics relevant to your organization's impact. As for the sector standards, that's basically focusing on what issues do matter. So what that is identifying the likely material topics for your organization. It's worth mentioning that GRI has focused on the sectors with the highest environmental impacts, and for now they have issued 3 sector-specific standards. One is related to oil and gas, the other is related to coal, and the third is related to agriculture, aquaculture, and fishing. They have actually promised that they'll be developing additional 40 standards to cover various sectors. If we look at the topic standards, it's as the title implies, it's basically related to disclosures that your organization would be using to report on certain topics. We're talking here about, let's say, biodiversity. We're talking about diversity and equal opportunities. We're talking about occupational health and safety. So if we move on, please. I have a lot of ground to cover on GRI and to untangle it. But before starting, if I may, any organization does have the option of either reporting in accordance to GRI or with reference to GRI. And this is one of the main important differences, because if you're reporting in accordance with GRI, then as it implies, you need to abide by 9 requirements that I'll be walking you through. But if you're reporting in reference to GRI, then we're talking about you using GRI as a reference note, or more loosely cherry picking amongst the standards. So if we look at the first requirement, that's basically applying the reporting principles of GRI 1, which I've just mentioned under the universal standards. And by that, we're talking about addressing 4 main topics. That is impact, material topics, due diligence, and stakeholders. And similar to all other frameworks, we're also actually looking at 8 or 9 reporting principles related to comparability, relating to accuracy, balance, and by balance in GRI context, we're referring to it being unbiased, completeness of data, and even verifiability. If we move on to the second requirement, for the second requirement, we're reporting under disclosures under GRI2, the general disclosures. So as I mentioned earlier on, these relate to the organizational practices. And in hindsight, it refers to 5 main themes. The first one being the organization and the reporting practices. For example, what are the entities included in the sustainability reporting, or maybe even for external assurance? The second one would relate to activities and workers. And by workers here, there is a differentiation between employees, your organization employees, and workers who are not employees, such as subcontractors, for example. Under that, also, the third main theme would be governance. So we're talking about, can we stay at number 2, please? Thank you. Governance, such as remuneration policies, or number 4, such as strategies, policies, or practices, and 5, stakeholder management. So how do you approach stakeholder management under GRI2? If we now move to the third requirement, please, thank you. This is about determining the material topics. So what we're referring here, and materiality, there's a difference between the concept of materiality, as Charles has explained, and there's a difference on stressing materiality in GRI and ISSB. In this requirement, we're actually looking at identifying the impacts of your organization being actual or potential, and ensuring that that is done on a recurring basis, it's ongoing. And to complement that, you need to determine what material topics for reporting are required. So you need to prioritize them. And some actual entities take this even further, and they do link them to the UN SDGs that Charles has explained at the beginning. For requirement number 4, it relates to reporting disclosures under GRI 3, and that is actual material topics. And if I may pause here, GRI does offer flexibility. So I'll be later on explaining that actually you can omit certain disclosures. But in GRI, there are around 7 disclosures between GRI 2 and 3 in the universal standards, the first column that I explained previously, where you're not allowed to omit. So in requirement number 4, you have the process of defining what a material topic is, and that you cannot omit. The second one would be actually the list of material topics, and that is also can't be omitted. And finally, it's managing each material topic and how you would the disclosure of how actually you're managing them. For requirement number 5, we're looking at reporting disclosures from GRI topic standards. So as I have specified earlier, I spoke about biodiversity, I spoke about health and safety. To delve a little bit deeper into this, so the topic standards are actually bifurcated into 3 themes: economy, environmental, and social. Under economy, you have 7 topics, such as anti-corruption. Under environment, you have 8 topics to report or to choose topics that are of relevance to you, such as gas emissions. And finally, it's the social silo, which includes 17 topics, and that includes employment, diversity, child labor, for example, depending on your business. If I keep moving forward to requirement number 6, and these are the reasons for emissions. So as I said, while there are around 100 disclosures amongst the different disclosures and requirements and standards provided by GRI, you will be allowed to actually omit certain information based on by documenting 4 reasons. And these are either it's not applicable to your organization, you have legal prohibitions, you have confidentiality constraints, or simply you don't have the information is not available or data is incomplete. And I'll be returning to the data layer actually later when I'm discussing the target operating model. Moving forward to the 7th requirement, and that's actually an interesting user-friendly requirement placed by GRI, and that's publishing GRI's content index. Basically what the content index is, it is a user-friendly way in ensuring that your stakeholders can maneuver around your disclosures and they can find the information that your organization has reported. Requirement number 8 would be to provide the statement of use, and as I have highlighted earlier, be it in accordance to or in reference to GRI. And requirement number 9 is actually notifying GRI, and that is done through an official email that is sent to GRI. If you are reporting in accordance to GRI, then the 9 requirements would be applicable. If you are actually reporting with reference to, then the last 3 requirements, number 7, 8, and 9, would be applicable, taking into account any disclosures that cannot be omitted. So that is GRI in a nutshell. And now I'll be actually handing over to my colleague Khadija to be taking you through the ISSB standard. Over to you, Khadija.
Thank you, Lamis, and hello to everyone. As Charles introduced earlier in the session, the IFRS Foundation issued new standards called IFRS Sustainability Disclosure Standards. This took place in COP26 in Glasgow as a result of many demanding from multiple nations during COP26 for a global baseline standards that could facilitate transparency and ensure that there is comparability between these disclosures. On the screen, you can see now the new structure of the IFRS Foundation. Within the audience, I'm sure we have a finance team members who've been working with what is called IFRS accounting standards for many years. For all of the rest, for your reference, the IFRS Foundation is a non-for-profit organization that was for many years responsible to issuing and maintaining the IFRS accounting standards, which is a globally adapted standard for more than 142 countries to report financial statements in nature. Because of their reputation and their experience in creating a globally used and adapted standards, this is why during COP26 they were tasked with this mission to create a global baseline standards. So this represents the birth of the new board. You can see to the right that a new board is named, titled International Sustainability Standard Board, ISSB Standards, and this is now the board's responsible to issuing IFRS Sustainability Disclosure Standards. Some of the key takeaways from this new structure is because the new board sets as a sister board to the old board, which is called IASB, responsible for accounting standards. These two boards are intended to work together to ensure that the outcome of both are highly connected. One of the key issues that Charles highlighted earlier is that there is very, very minor connectivity between sustainability reporting and financial reporting. And one of the targets of the IFRS Foundation through the issuance of this standard is to ensure a higher level of connectivity. And this is established through the fact that the two boards are intended to work together. This is also reflected in the words and methodology used within these standards. So some of the same concepts are used in accounting standard are now adapted into the IFRS Sustainability Disclosure Standards. One of the good examples is, for example, the definition of materiality. So within the two sets of standards, the definition of materiality is the same, financial materiality. Also, the intended user of such standards. IFRS accounting standards comes with intended users to provide information to the investors mainly. Those are the primary users. The same audience are served by the results of the IFRS Sustainability Disclosure Standards. This would result in a connectivity in the standards themselves, and the output of these standards will also be connected. A second key message that we want to highlight as well in this slide is the fact that adoption of these new standards is not by extension. So if a country, for example, Oman, that adopted IFRS accounting standards before many years, it's not required now to adapt to the new standards. However, because of the fact of the need that requested the IFRS Foundation to issue these standards, what we're now seeing is that governments around the world are starting to consider how to adapt or use the new standards for their investor market. So this is something that we could expect to happen in the region and in Oman in the future. However, till now, there is no announcement from Oman governments or any parties within Oman about that adoption. Across the region, there are many countries that announce adoption or they started a local consultation. A third element that we also want to highlight, which is actually questions we've received through the registration process, which is what about assurance or audit? So as well, from the IFRS Foundation's point of view, they don't have remits to require assurance or audit in some sense over this non-financial information. However, it's expected that with time, this will grow to ensure high-level trust of these standards. And this is something that reporting entity needs to keep in mind, that whatever they disclose needs to sometimes survive in the future the test of the assurance. If we moved on to the next slide, we will kind of outline here how this has actually happened. So the IFRS Foundation did not start from scratch. They build on the existing framework in the sustainability reporting landscape. So as Charles mentioned, that we have many voluntary incense reporting frameworks such as SAS, TCFD, you can see on the slides as well, CDSP. The IFRS Foundation, when they've announced this new board, they work to consolidate few of the really well-established sustainability standards boards, and they build on their existing work. So for example, SASP is a body that issued industry-specific standards, so now it's consolidated within the IFRS Foundation. TCFD is also another good example, and since starting of 2024, TCFD is no longer exist in isolation, it's now part and controlled by the IFRS Foundation. Also, the slides outline the relationship, and as Lamis introduced that, the GRI and the IFRS Foundation signed a memorandum of understanding that they will be working together to ensure interality and alignment between them up to the maximum time we still have. If we move on to the following slide, this is where we will actually unpack the content of the standards. So IFRS S1 requests the entity to disclose information about sustainability-related risks and opportunities that is useful to the primary users of the general purpose financial reports in making decisions related to providing resources to the entity. So IFRS S1 acts as the overreaching standards. It's equivalent to conceptual framework and IAS under the accounting standards, and it requires over all topic of sustainability reporting. So it's not only climate and it's not only environment. It covers all aspects such as social capital, human capital, leadership and governance, and business model and innovation. If we moved on quickly to the following slide, please. Lynn, if you can move on to the following slide, please. Okay, I think we're having connection issues. Yes, no, one slide back, please. Yes, thank you. So let's just also unpack the objective of IFRS S1, as it's the overreaching standards that really sets the scene for the rest of the standards that yet to come. Information about sustainability-related risks and opportunities. Sustainability-related risks, according to the ISSB board and common methodology, are triggered by the fact that the entity depends on resources and use resources and relationship in order to create value. This dependency relationship actually could trigger risk and opportunities. And the new board is asking the entity to disclose information about these risks and opportunities that could reasonably expected to impact the company's prospect. It means that it should possibly have impact on financial statement, cash flow projection. Again, this is because it's investor-focused disclosures. This is the objective of IFRS S1, and again, it provides an overreaching requirement. IFRS S1 is intended to work with other IFRSs on sustainability disclosures. At the same time, the ISSB board issued two standards, as I've mentioned, IFRS S1, which we've covered, and they've also issued IFRS S2, which is the climate-specific disclosures. Because the climate is an important topic, the IFRS Foundation decided that it should be priority number one to provide a standard that the entity can use. IFRS S2 is built on TCFD structure and content as well, and it requires a specific disclosures requirement for the topic climate in case this topic is material to the specific entity that we are discussing. Both standards are intended to work together. So IFRS S1 provides overreaching requirements, disclosures requirement for all topics. As I've mentioned, all dimensions, social capital, business and innovation, leadership and governance. That's the minimum requirement according to IFRS S1. IFRS S2 comes to add extra layer of specific disclosures requirement only related to climate. The IFRS Foundation also intends to issue IFRS S3, IFRS S4, disregarding the topic. So we will have a full suite of standards that are going to come in the next few years to cover the other specific topic, like water, biodiversity, social capital. Till we have those, the entity is advised to refer to other standards like the SASB standards, for example, or GRI or ISRS standards. If we move on to kind of summarize the objective, if we can move on, yes, and another slide, yes, thank you. So this is where the IFRS accounting standards and the IFRS sustainability disclosure standards come to kind of give the big picture for the investor. So IFRS accounting standards provide information about the historical position and performance, which is very valuable information. At the same time, the IFRS sustainability disclosure standards come to give indication about the entity's future out profile, in some sense, how the entity's business model and strategy is resilience and what is the risk and opportunity that could impact from a financial materiality point of view on the entity's operation. If we moved on to very quickly kind of outlining, unpacking what is the disclosures requirement actually within these standards. So the standards request the entity to disclose risks and opportunities about the topic that's deemed material for them. And they're asking the entity to disclose 4 kind of pieces of information about these risks and opportunities, which is risk, strategy, risk management, metrics, and targets. Governance mainly covers how the entity is actually governing these risks and opportunities from sustainability, how the board is involved, who's the committee that's taking care of this, and how this is operationally happening. A strategy reflects the disclosures about how the entity's strategy is embedding these risks and opportunities, and what is the transition plan, for example, that the entity placed. what is the actual quantification of these risks and opportunities and how this is connected to the financial statement. Risk management pillar covers how the entity is managing these risks of sustainability issues and the opportunities as part of their daily risk management process. And finally is the metrics and targets, and this is where the definitions that Charles kind of gave, like scope 1, scope 2. These are examples of metrics that the entity is using to measure current situation of performance in any specific environmental or social topic and what is their intended target. Before I hand over to Charles, to recap this, the entity is the same entity under the definition of IFRS accounting standard in terms of the reporting entity. So if you're issuing a consolidated set of financial statement, the same group will be considered from this reporting under the new standards, except with one small tweak, which is the acknowledgement that risks and opportunities could be triggered through the entity's value chain, which is a concept that we've discussed as well. This adds a slightly extra layer of complexity, so the entity now needs to consider their value chain and any possible risk and opportunities that could emerge, and they need to disclose on them. Again, all of these disclosures requirements need to be highly connected to the financial statements and to the wider reporting that the entity issue. So the hope is that the sustainability reporting under ISSB will be highly connected in terms of disclosure and also in terms of assumptions. That was slightly big and quick, but Charles, if you want to recap on the both GRI and ISSB.
Thank you, Khadija. Thank you, Lamise, for going through those. So we've touched there upon the two reporting frameworks that we see as being the most relevant for Oman and for actually the whole of the region. So the reminder, the MSX disclosure requirement, that is a requirement to follow effectively the GRI. So the one that Lamise was talking about, broad ranging, effectively a double materiality threshold. The ISSB consolidated together a number of different, say, groups focused on investors, focused on connectivity with the financial statements. If I'm, again, talking to companies, almost a no regrets approach, if you like, to thinking about sustainability reporting now, my advice would be think about both of these posts. I would also say if you've got European operations, don't ignore ESRIS, the European standards as well. Again, there's commonality, but make sure that you're seeing the links between these areas. But we finished there the sort of detail. The last little bits that we wanted to talk about, though, was the way forward. So what is next, effectively, for organizations having to produce their sustainability reports? Now, we're talking at the moment to many organizations in Oman and across the broader region, and there are a number of sort of key considerations that keep on coming up. So, Lynn, if you just move forward to the next slide, we can just talk through those, some of those key considerations. So these are all sort of factors which I think organizations have to think about when they are looking at reporting on their sustainability. We've discussed a lot today on materiality. What are the material risks and opportunities, and what's the material information that needs to be disclosed? So slightly different between GRI, which is broader than ISSB, but again, you've got to come up with that materiality assessment, for your organization and your industry. You will need a transition plan. How are you going to transition? Obviously, your organizations are transitioning, but your reporting is going to transition as well. Think about your reporting boundary. ISSB's reporting boundary is the same as the financial statements. What we see at the moment for some organizations is that their reporting boundary for sustainability has actually been slightly different to their reporting boundary for the financial statements. Those have got to be harmonized. Lots of concern in this region regarding scope 3. I talked at the start about scopes 1, 2, and 3. A lot of concern around scope 3. That requires information from the value chain, a broad range of stakeholders. There's a lot of perhaps some estimation involved in determining scope 3 in particular. It needs to be thought about. How are you going, as organizations, you're going to obtain and report on that scope 3 information? There are standard industry metrics and targets. Again, in Oman, as I said, the MSX requirements, there's GRI, but there's actually 30 specific targets and metrics that will be required to be disclosed from 2025. So, Oman is following GRI, but it's also creating a set of metrics, common metrics that it will require all companies to follow. And then the last point there, don't ignore the connectivity with the financial statements. ISSB in particular, absolutely explicit for its connectivity with the financial statements. Sustainability reporting and financial reporting aren't going to be separate. They're going to have to be harmonized, and the two are going to have to work together. My very last point I put on the slide there, initially in Oman, assurance is not going to be required on these reports. We are already seeing in the world, though, that assurance is coming. Initially limited assurance, certainly certain metrics perhaps, or on almost like a negative assurance. It's expected it may well move to say almost full assurance, reasonable assurance, which is in effect audit of these areas. So those are some of the sort of considerations we're seeing. Finally, before we move on to Q&A, I'm just going to invite Lamise actually to talk a little bit about practicalities of reporting and what you need to think about in actually developing an operating model for reporting.
Thank you, Charles. If we can move to the next slide, please. Thanks a lot. So we've heard a lot about theory today. We've heard about what needs to be reported, but now actually getting back to basics and looking at how are we going to do it. It's not an easy exercise, so we need to see how we're going to actually implement, be it GRI or ISSB, or looking at sustainability reporting and looking at something which is an outcome-based framework. So how can we help you? Actually, by looking at it, you need to have a 360 view. And I've here provided the design layers for the target operating model. And actually, there is a bit of interlinkage between each and every layer and sustainability reporting, regardless of the framework. So I'm taking you from the far left to the right, by looking at the service delivery model. So who will actually be helping you as an organization deliver that report? Are you going to do it in-house? Are you going to do it out-house? Presuming that it's a service, how would you actually be delivering it? By referring to one of the questions, there was a question about the people layer and actually who would be doing this. So the question is not only who, the question is where maybe does it sit as a practice? Does it sit with finance? Does it sit with ESG, presuming you have an ESG or sustainability team, or strategy? What are the roles of financial reporting, internal audit, the C-suite, the data layer, the data team, the technology team, actually looking even at the sustainability and the strategy team? Each person is an actual stakeholder with expectations and responsibilities when we're looking at sustainability reporting. We're looking at the process. So similar to any financial process, we look at this as an accounting standard, if we're looking specifically also at ISSB or GRI to on a lighter touch. So we're looking at the measure to report, taking you through the journey of the functional process of how will you be able to actually report these disclosures. A big player here is technology and data. Do you have the data points that are required? Do you know actually what are you calculating? If you have the data points, what is the history that you're looking at? Looking at your ERP systems or the technology or the system suites modules that you have, can they be able to support you not only at reporting the disclosures, be it regarding any framework, but do you have the technology to support you calculate and do these calculations that, for example, Khadija was reporting to? When we're looking at the performance and insights and data layer, this is more of an EPM view of the target operating model. Would you be able to provide different cuts and reports related to your managerial reporting for the sustainability reporting? What kind of insights can you provide or actually delve? Would you be able to look at KPIs or benchmark yourself following an additional year of reporting? And finally, and also with a lot of rigor that is required, what is the governance structure that might be required? Who in the C-suite has been trained actually to take that decision? Who would be able to sign off the sustainability reports? What kind of policies and procedures that are required from policies and procedures that are required to actually assist you in sustainability reporting. So basically, all of these provide a 360 for the target operating model of any function, not only finance. But from this perspective, we're looking at it to actually tackle sustainability reporting. While people might speak about sustainability and ESG lightly, when you delve into the details for sustainability reporting and the how will you be able to tackle it, it's actually a full-fledged project that requires a lot of help. And if we add to the mix the materiality aspect to it, then it does become more complicated. So this is the how, and I hope that I've answered one of the questions. So this is us wrapping up. Charles, I'm not sure, do you have any recap for the way forward, reference sustainability reporting?
No, thank you, Lamise. So what we covered over the session today clearly is that sort of general background as to where the different frameworks have been and what's happening on a global basis, and then drill down for Oman in terms of what's happening here with the MSX requirements, and then also the ISSB requirements, which we are expecting to become very, very common mandatory requirements for this region. And what Lamise has just gone through, thinking about the actual generation of this report, and that sort of the no risk basis. We had some questions submitted to us over, say, by panelists. I think hopefully we've picked up some of those questions, but if I just pick up the last, sort of couple of questions that have been sent to us. We were asked a question about, how to generate the report and how many stakeholders have to be involved. What I would sort of reiterate is what Lamise said at the end. You do need to actually, it's a proper, report going out to investors, which has got to go through a lot of the same sort of rigor and processes that you put any form of, annual report, financial report out to investors and others. It's got to have a proper governance model. It's got to have, proper, potentially technology to underpin it, and processes, etc. In terms of how many stakeholders are involved, our experience is that quite a number of stakeholders in the organization will have to be involved. Certainly, organizations with, many organizations have sustainability teams. They will have a big input into it. Financial teams are going to have inputs into it. It's an external report which investors will look at, so investor relations need to be in there as well. You'll have to think about the sort of operational management of the organization. That's where a lot of the data is going to come from your organization. So you'll have to get those involved. They'll have to understand what's actually required. Legal teams have to think through what are the, make sure that they're comfortable from a legal sort of perspective. It very much is all of the organization in the same way that an annual report and the way you generate that incorporates a lot of people in the organization. We had a question around how sustainability reporting could help investors and how external auditors are involved. On the investors' point, say the ISSB report is specifically for investors. GRI, one of the stakeholder groups, is investors. We know from our experience, investors are increasingly starting to look at sustainability when they're making their investment decisions. They're thinking about, ESG metrics, say even sometimes explicitly. There are investors looking at financing, green bonds, green investments, where explicitly ESG is part of the analysis, almost the covenants on those. Even if they're not, say, specific green bonds, green types of investments, we know that investors are looking at things like ESG rating for organizations. They're considering, where organizations are relative to each other, when they're making those investment decisions, because investors, that is something that your investors, their stakeholder bodies are interested in. We had an explicit question on external audit and how external audit's involved. Now, at the moment for Oman, there isn't an external audit requirement. There isn't an assurance requirement. Europe is the furthest ahead in terms of assurance. That has got limited assurance, mandatory limited assurance from this year. expected from around 2028, there will be reasonable assurance on that report. We are already, though, seeing many organisations starting to provide at least limited assurance on certain metrics that they are putting out, just to give the investors and stakeholders confidence. We would expect that will come through. Certainly, again, the ISSB standards, the more recent ones, those have been written with a view that ultimately they will be assured. So we would expect that as time progresses, there will be a need to have those reports assured. And then I suppose the final question we did have from somebody, just how is it going to impact on as well? As an organisation, potentially you've got new reports to produce that you never reported previously. So that requires you to build all of those processes to generate the reports, make sure that they are robust, that they are factually correct, that they are giving the appropriate presentation to your business. It is going to be an extra piece of information that investors and stakeholders are going to look at with the MXX disclosures. As they become the same for all companies, there's going to enable more comparability between organizations. There will also have to be comparatives within an organization, so people can track your progress around sort of meeting any sort of targets and things that you put out. So quite a big impact, a whole new sort of reporting stream for some organizations in Oman that they haven't reported on previously. We did get one question on who is it applicable for. The MXX requirement is applicable for listed companies at the moment, so they're the only ones that have the mandatory requirement. However, we are already seeing that certain other non-listed organizations, private organizations, or large public interest but unlisted types of organizations are looking at the requirements, considering whether they should put something out. So that's, I suppose, completed what we hope to go through on this session. So thank you for your time with us today. Hopefully you found the session useful. We will ensure that the recording is available to everybody, so if you want to recap. And clearly, if you have any questions that come through to you, please do contact us at KPMG or any of your usual KPMG contacts, and we'd be delighted to hear from you, explore this area in more detail. But with that, I'm going to close this session now. Thank you very much for your attendance, and hopefully you found the session enlightening and rewarding. So thank you very much.